Hello, welcome back to Wealthy. I'm often asked, property or shares, which one is the better investment? So let's just break that down a bit. So let's start with entry costs. So buying a property requires generally a big deposit, typically 20% plus stamp duty, legal fees, inspections, all those sorts of things. So on an $800,000 investment, that would easily be $160,000 up front if you were applying a deposit. Now, this can be negated or reduced if you're borrowing against another property's equity. So just say you own your own home or have large equity in your own home, you could potentially borrow the whole amount of the investment property against that home, essentially. Of course, you'd be borrowing more if you went down that path. Meanwhile, with shares, you can start investing with as little as $500, I guess, through an ETF or a small managed fund with no stamp duty, no legal fees. Of course, it will take potentially longer to gain a strong equity position if you're investing small amounts rather than borrowing a big amount. Historically, Australian property has grown around 6 to 7% a year. So some years it's much more than that, depending on the market you're in, where you're living, etc., or where you're buying. While the ASX 200, the Australian stock market, has returned around 9 to 10% per year, including dividends. Property investors often use borrowed money, so gearing or leverage, to boost their returns. As I mentioned earlier, it increases risk, but that can be potentially managed. So there are strategies around that. Need quick cash? Well, shares can be sold in seconds, while selling property can take months and comes with agents' fees and taxes, etc. Of course, owning property also comes with ongoing costs: mortgage, interest, council rates, insurances, maintenance. With shares, potentially there's only a small brokerage fee and a tax on capital gains when you sell. Important to remember that there'd also be tax on capital gains if you sell a property as well. Property can be hands-on, managing tenants, repairs, dealing with vacancy periods, etc. A good agent can help with that, of course. Shares, they can be quite passive, so you can potentially invest and forget, letting your money work for you. Now, some investors in shares choose to be quite active with that as well. So which is better? Well, as usual, it depends. If you prefer hands-on investing and leveraging borrowed money, property might suit you. If you want diversification, liquidity, and passive growth, shares could be the better option. Or why not both? Many Australians build wealth through a mix of property and shares, understanding that they have different characteristics and have different effects on their long-term plans. Anyway, hope that helps a bit. Make sure you do your research and get expert advice before investing. Thanks for tuning into Wealthy.